Hi, everyone. I'm Rick Bensignor, and welcome to this week's In the Know Trader Show. Well, the stock rally is on a mild pause since last Friday's jobs report came out better than expected, making investors far less sure that the Fed is going to cut by 50 basis points at their upcoming FOMC meeting later this month. The S&P has reached as far as 2996 or so before pulling back Friday, Monday, and today, but it's still only about 1% from the high made last week. So in the scheme of things, not a lot to worry about. This week, we're going to kind of cover three different topics. I want to look at, we're going to start with results, and we're going to talk a little bit about results both in how you look at the markets and how you actually do, S&P sector performance, and then also this week we're going to focus on the industrial sector of the market. We haven't looked at this group in quite some time, so we've got a bunch of names here. These are widely held names that go across the entire industrial space, so we will get to as many of them as we can. I want to start off by looking at results because the whole reason we play the market is to make money. Now, depending upon what your goals are, everybody's going to have different elements of risk that they're willing to take, different time horizons. So if you're 50 years old, you're going to have a different way of looking at the markets than you would if you're 25. So there's lots of factors that come into play when you look at what your results are over time. But the bottom line is that this is whether we call it a game or not, but I'm going to use that term. This is a game about making money and making as much as you can for the risk tolerance you're willing to accept. So it's a good approach to look at your results over different times. And I don't mean look at the market. You don't necessarily have to look at the market every day or look at how your 401k is doing every day. That is not what I'm saying. But you certainly want to look quarterly, semi-annually. You want to kind of see how you're doing, how your investments are doing, and tweak as needed. And that doesn't mean chase the market or when something's down, you immediately dump it. Again, you have to look at it in relationship to the big picture. And one of the things that I want to kind of talk about today is just results and kind of how we've done now these are numbers that I've just put up here. These are for the institutional newsletter I write. For In the Know Trader, the individual investor newsletter, we don't track results simply because we have people coming in every week who are going to have different results because they're not putting on the same trades as everybody else is. And we have more leeway in how we exit trades, so it's much harder for me to track. I kind of can tell where we get in, but I can't always tell where we're getting out because I give multiple ways of getting out of trades. And again, it also depends on when you got into them, and if each issue we're writing about what we see coming, as well as every open trade we have, I update the targets and stops. So again, people are going to have different results, and therefore it's much harder to track on the individual investor in the no trader side. But for institutional clients I have, where I write a weekly global macro report that comes out Sunday nights, I want to show you the results that we've had for the last 2.5 years, because these are the same models that I use for in the no trader. So we don't have the exact same results, but the process is the same. So year to date through June 30th, the institutional newsletter I write is up 68.7% on invested capital. Now, that's not comparing to the S&P because the S&P is essentially always invested in. Here, our results are based upon invested capital. So for each trade you do, we equal weight them, and we come up with a result of the trade. So if I, let's say, only say buy a half a position into stock XYZ, if that returned, let's say, 5%, because it was only a half position, I'm going to say you only made 2.5%. You actually made 5% on your money, but in P&L terms, you only made 2.5% because I equal weight all trades. There are times I say, put a double weight trade on, meaning take 2 times what you normally would invest into a single name. And because let's say that's something I have a very, very strong belief in, and then the results, same thing, I have to cut them in half because I equal weight everything. So on an equal weighted basis, this year, we're already up over 68%. Last year, we made 24.3%, and the year before, 75%. Now, these are true numbers based upon entry and exit as best as if we tell you to buy in a range of, buy stock between 52.5 and 52.40. If it gets down to 52.40, we'll assume you paid 52.45. So we'll take the average price of, entry levels and the exit levels, which are as close to actual trading as we can guesstimate. The other piece of the data here that's really important to look at, and most people on the individual investor side have never heard of what a profit factor is. So let me define it for you. A profit factor is the ratio of how much money you've made on your winning trades divided by how much money you've lost on your losing trades. And this is a number that hedge funds will always use as part of their marketing material, in the sense that a profit factor of anything near 2 or higher is considered solid, meaning if you have a profit factor of 2, you've made twice as much money on your trades as you've lost. So here are the 3 profit factors also over the last 2.5 years carried through this year. So this year has been absolutely phenomenal. We have a profit factor of 9.17, essentially meaning you've made $9.17 for every $1 lost in our trade recommendations. Last year was 1.73, and the year before 6.67. And again, anything even close to 2, the street looks at as being good. Anything above 2 is considered very good. So you can see the consistency at which we also make money. So it's not just the percent returns that you make each year, but it's also how much have you made relative to how much you've lost. And I can tell you that these are outstanding numbers. And I bring it to you because this business is about results. And if you're not getting results in all the different newsletters and places that you get information from, then you should evaluate, just like you do your portfolio, you should also evaluate where you're getting your information from and the type of results you get, because you might as well pay for results. All right, let's take a look at S&P macro sector performance. The chart on the right is current through yesterday's close over the last, or basically January 2nd through yesterday. And the chart on the left is the chart we had last week. So it's 1 week older. So this way we can compare where we were currently to where we were a week ago. And the things that stand out the most here is that REITs had a phenomenal week. You can see that in relative terms to the S&P, they're back to outperforming by over 8%. Or what we'd say 800 basis points. So it's 811 basis points of outperformance. So since last week, they had a rather strong relative week. Tech looks pretty much the same. Go to the far left of these two and take a look at consumer discretionary. And they've also picked up in the last week. So we're seeing they're up at 4.42 versus 3.27. So they picked up over 1% of outperformance last week. Notice on the left side that utilities had been down almost 2%. They are now actually outperforming. So UTs have gotten a bid this week, which means, you take a look, you see utilities and real estate have gotten a bid, which is kind of interesting, because with last Friday's jobs report and the fact that interest rates went from 1.95 on the U.S. 10-year to 2.05 in a single day, you get the sense that financials could start picking up a bid, and that real estate and utilities would not, and yet financials really haven't moved, but real estate's come back. as have utilities, which means the market is still quite defensive and not sure of upcoming the upcoming move from the Fed and what's going to happen. And that's, of course, part of the reason why we've seen the S&P come off a bit. But even today, as I speak right now, the S&P is only down 5 points. It was down about 10 or 11 to start the day, so it's recouped. And it's still at 2970. We're still 1% from the all-time high made last week. So as much as people are talking about that the market's really concerned about whether the Fed's going to cut 50 basis points, 25 basis points, or do no cut at all, and the market's betting on a 25% at a minimum, but greatly reduced the chance of a 50 basis point cut, the market's still only 1% from all-time highs. So a lot of what you're hearing on TV seems to be more concern than the market is actually showing. So again, I like to look at these charts. These are, these performance charts come from StockCharts.com. They display them terrifically because, it's a very visual chart, and right away you can see the differences between performance a week ago and how things are currently doing. And I like to look at this each week. And I used to only look at the current week, but then I thought for In the Know Trader, in this podcast, let's always put the prior week on also, and that gives a very good way of seeing what's shifted in the past week. Okay, so let's take a look at charts to get a sense of what's going on in the S&P first before we get to the individual industrial names. So look, here's the most popular looked at institutional benchmark there is the S&P 500. And recently, we popped up to almost 3,000. We took out it's not fair to say a triple high, but certainly we stopped last October or late September around 2940, then in May around 2950, then around 2955 to 60. In June, we pulled back just a little bit, and then we finally pushed through. So the way I look at this is I still think we're going to 3032 as our next upside target, and then a bigger up move over time, as long as we don't have about a 5.5% pullback from any high, I then say 3184 is kind of the next upside target beyond 3032. And one of the things that this move did recently, pushing to the 2996 level, it took away any chance that you had a head and shoulders top. So if you look at this section here in February into early March as a shoulder, then kind of the head coming down again to the same level, around 27 and a quarter. You still had a chance to do that, but by making new highs, you've taken away at least the head and shoulders potentiality. But what you still could have is an ascending triangle or reverse ascending triangle in the sense that, I still think that this can push up and go and test this trend line too that connected the tops as being, it's still a potential larger topping pattern, but it's not the head and shoulders anymore. And depending upon how much time it takes to get there, you can see that in another month from now or so, the 3184 level lines up with the early part of August. So if we still keep an upward bias and the market gets good news, you could still run another 3% a month, which would be a heck of a good month. But I'm just saying that I still think I don't have any reason to give up on the market yet. Secondly, we can see it is, as I record this, it's still late morning on Tuesday, but the S&P has come back from a weaker opening to actually be trading on the highs of the days right now. So again, whatever minor pullback we've had over the last few days is still very minor and less than 1% from the all-time highs we saw last Thursday. But let's get to the most important part of the S&P chart right now, and that's this level that I've circled in here. Specifically, it is 2879. That is a bearish propulsion level. Propulsion is a DeMark model that we use as part of our analysis. And to me, as long as we stay above this level, 2879, then I can even, I can live with a pullback that takes us back beneath that 2950-ish level. And a lot of people are going to say that's really bearish because we broke out and we got back beneath. I'm saying that as long as we're above 2879, we're okay. And unless this gets breached the proper way with a qualified and confirmed close underneath, then to me, the bull market lives on. If we get closes underneath this level and proper closes underneath this level, then I truly question the longevity at this point and would probably suggest to people to put on significant hedges. And it's very easy these days. A lot of people don't realize just how easy it is to hedge your exposure instead of just simply dumping out of stocks. There are things, and then of course there are tax implications once you sell them. There are things that you can do in order to protect the downside. The two simplest ones for an individual investor are to use ETFs. Now, you could either short spiders, SPY, which is the most liquid and traded instrument there is in the equity world, or you could, there's actually an ETF that's an inverse of the S&P, and the ticker symbol is S like Sam, H like Harry. Buying that ETF is the same thing as being short the S&P. So if you wanted to hedge your exposure, you can buy that ETF, and that ETF goes up as the S&P goes down. So that's your way of hedging your exposure in the market. So, again, of course, you can use futures if you are set up to use futures, but there are simple ways to hedge your book of long exposure without necessarily, taking all the tax implications of actually getting out of individual names. So if you have a portfolio that somewhat replicates the movement of the S&P in general, so if you have a broadly diversified portfolio, it's really easy to hedge your books now. And to me, that level's, a proper breach under 2879. Okay, let's get into the industrial names. We said we were going to take a look at a bunch of names today. So we're going to start off with Boeing. And, look, this is a very widely held name. Obviously, it has had substantial troubles with their jets. You can see the big, this is a weekly chart gap down that took place in February when the news came out about the MAX jets, and it's been struggling ever since. But there's a few things here to note. Notice how many upside exhaustion signals we had going back to even late 2017. This 13 signal is part of the DeMark model of upside exhaustion. So here you're showing upside exhaustion. Here you're showing upside exhaustion. Multiple signals, and 2 weeks or 3 weeks before the all-time high, upside exhaustion followed by a setup 9 count. That 9 count is 9 consecutive Fridays that the close was greater than the close from 4 Fridays prior. That's also a potential near-term turning point. So we had everything saying that, in fact, let me take off the cloud chart for a second. Notice also and it's not a perfect pattern here, but I'm just going to kind of grab a high here. There is some type of sense, a diamond pattern. And my guess is, this move here was the absolute height of the diamond pattern, and now you're making or potentially have the chance for lower highs and higher lows. So again, it's not a perfect pattern, but it's a long-term distributive top. And of course, this hasn't broken down yet, but it's just something to pay attention to, especially given the news that's out and the fact that, you have all these signals that are saying upside exhaustion. Now, interestingly, I happened to notice this just before I went on air today with you guys, that look at the daily chart. So that upside exhaustion, downside exhaustion, upside exhaustion on the daily chart on the day it made the all-time high, and that led into downside exhaustion here, and once again, downside exhaustion. So from a trading perspective, we're getting closer to a trading bottom that's still holding above the uptrend line from the Christmas low back here. So if I was going to look to buy this against the trend line or something close to it, I as a pure trading thing, somewhere just, I don't know, between 335 probably and 340, if you like the name, you could bid for it. But you want to have a fairly tight stop because you don't want to see this trend line and this TDST line at 335 taken out. That opens the door for move to 320 next, if that happens, if not a greater down move. Once we get under 300, I'd start getting interested in the name again, potentially. But from pure trading perspective, that's what I see in Boeing. Let's also take a look at UTX, and I generally want to stay in the weekly time frame. Let's get rid of all these trend lines. So here's UTX, same thing, upside exhaustion signal. Let's take an ellipse, we'll show you here. So this signal followed this 9 count here, so double high, what actually ends up being a triple high. The risk level on this 13 count is this level here at 144. So after the big sell-off in the fall, we come all the way back, make slightly new highs, stop exactly where you'd expect it to. You have to close above here properly in order to get a new leg up, and it's come down again. So this too kind of has a, look, around the top, the Christmas sell-off, I'll almost disregard that because it was so V-shaped, and around the top again. You're smack in the middle of the range. There's nothing to do right here, but if you're a long-term holder of this name, this is the type of thing that I don't think it's crazy to take some profits on it, anywhere from 130 to 145, and then if it gets above 145 and makes new highs, and gets above this 144 level properly, then perhaps I put it back on. But with a MACD cross here, I don't think it's crazy to just take some off the table. One more defense name, here's Lockheed Martin, also last week trading on all-time highs, so similar to the S&P. This has actually tracked the S&P somewhat well this year, although it didn't get the sell-offs nearly as badly, and near 381 and change is the risk level from this 13 count. So when this suggested upside exhaustion, it certainly was a very good signal. It's come all the way back. So a little higher than where we're trading is some resistance. So again, you could take some off the table. And on the downside here, the other thing to do is you just stay long unless you get Good Friday closes under 340. Breaking under 340 properly suggests the next move gets down to 310 or so. So that's kind of how I see things there. Let's move on to different segment. JCI, Johnson Controls, very different looking chart. Longer term here. So let's take the lows of 2016. So basically your Christmas lows came tested, slightly exceeding, came storming back. You've broken obviously above any downtrend line that you could have had from those highs in 2016. Let's just check. Okay, so you basically have also long-term double high in and around the, let's just say just north of 48 from back here. And this area in here back in 2016. So double top, double bottom. You're getting some initial signs of upside exhaustion here. If it keeps going anywhere from 46 to 49 is, again, a zone you could take profits in. And if you don't care about the tax side of this, you sell it up in there and you put it back on if you break out above 49 properly. But this has been trading range for a few years here. And I'm right here, right now. I'm not a buyer. If anything, I'm a little leaning towards taking some profits. That's that. Let's take a look at Emerson. All-time highs made on 13.9 counts. We sell down into the Christmas low bounce. Now, this was a downside exhaustion signal back in, looks like, the very beginning of June, and we've moved up since there. So you've got lots of price activity. There certainly are some buyers. Look at 2018, except for the fourth quarter decline, right? All the buying, this concentrated buying and selling, so there's lots of heavy volume up in here. You get one push through to take out some of the shorts, and of course you take out some of the longs. Thing is, you're failing here beneath kind of the breakdown level. And so this still says to me that there's overhead resistance anywhere from about 74.5 up to 79-ish is resistance. Support now anywhere down to, 55.5 or so. I'm kind of neutral to name. Wouldn't do much here if I didn't have to. Honeywell, all-time highs. Great long-term chart. Let's see. Again, I'm going to take off what we don't need. High MACD level, kind of similar to where we've stalled again. Got a 13 here a couple weeks ago. Same thing. I'm not a buyer up here. If anything, I'm a seller anywhere from here to 182.70 or so, kind of a sell zone. Watch this level at 167.40. Friday closes underneath this. If, again, on a notice here, let me give this as an example right here. here's a propulsion level that if properly breached at 163.28 would suggest that you would go down here. The thing is, it didn't properly breach it because the week before we touched it was a down close relative to the week before that. This down close says that there's more likely a chance that this is a support level than a resistance level, not resistance level, than a breakdown level. So the minor breach here underneath that purple line of 163 was not a reason to be a seller. It's actually a reason to be a buyer. Same type thing here now, 167.41. You've got to watch this level and look at the week before we would come and touch it now to see if that was a down close. If it was, then I become less concerned about a breach of that level. If we were to now sell off and take out the May low of 162 and change, then I think you probably get down to 156. If not 151, so that's or 152. That's what you'd have to deal with now. And again, look, highs back here in January of 18, similar highs. This one pushed through and pushed through again. So if you take out this low here, you've got a lot of trap buyers in the last several months, and that's the only concern. 3M. So much weaker name. We can draw a very valid downtrend line. There's not too many of these industrial names, or at least there's nothing we've looked at really that has such a clear-cut downtrend line. So we do have, there is some support against this year's lows. The bigger support, you have to go all the way back to 2014, 2015. That comes in near 135 or so. So if we take out these lows, this year's lows, you have room all the way down here. On the upside, I'd say next move, if you can get through 175 properly, you get to 190. And that's also, again, kind of a breakdown point place you might want to take some profits. We got time just left for one or two. Let's move over to the airline area. So here's Delta. Let's take off this trend line. So Delta, like multiple times we've seen in the last year and a half or so, lows that have come into this 45 to 50 range. And each time we kind of get up here in the low 60s, we've stalled, and even this week's high is 59.90. So we are up against propulsion exhaustion level. If you're a trader, you take some off the table. Longer term, you look for a breakout, and this thing targets 67 to 73. The last one we're going to look at is let's go to the railroads. Let's take a look at, let's say, UNP, just to get a flavor of what's there. And so this too is, I assume this should be all-time highs. Let's see, yeah. So all-time highs does have some exhaustive signals up here. Nothing much going on other than, I quickly look at this and I say the basic uptrend line is intact. The Christmas low held the uptrend line from the 2016 low. I'm not necessarily a buyer here, but if I'm long, this is a name I hold, and I only get concerned really if we break this trend line, or you could even say use the launch off of the Christmas low. So for long-term holders, you're talking 136 or so as the real major breakdown level. Otherwise, I can live with most of this. Cloud models held all the way through too. So that's it for this week. Hopefully you got a good sense about understanding results and what profit factors are, and also a good look into the industrial sector. That's it. I'm Rick Bensignor. I do want to, let's just quickly get you back to how to contact me. Rick at inthenotrader.com. Also check out our website, inthenotrader.com. Lots of videos up there, information on how to be a subscriber to the individual investor newsletter. That's it. I'm Rick Bensignor for In the Know Trader and StockCharts. Have a good week.